verifiable way, in an open source way, and in a distributed way. And the opportunities that it's going to bring about are, at least some of us in this room believe, are going to change the world. So that's my portion. I'm going to hand it over to Dylan, and then we're going to hang around as long as oh, and I didn't mention, we have a Slack group just for Hack Reactor cryptocurrency enthusiasts. If you're interested, I'm going to open up the Slack group, and you can enter your email, add yourself to the list, get an invite. We have people dating back even to before we were students, from all the Hack Reactor groups, remote as well as in the different schools. There's people that work in the industry. You can ask for career advice, post your projects, get ideas, feedback on things that you've been doing. It's pretty cool. So stick around if you're interested in that as well. I'm going to hand it off. Can I use that?
What's up, guys? So I'm going to be talking about, okay, so first I'm going to talk about just a little bit, like a really short little bit on how to measure success in Bitcoin, because a lot of people just look at price, but there's other metrics that you can look at. So yeah, most people look at price, but there's other indicators of like a good currency, which is low volatility, high adoption, funding in the area, participation, and then also like the number of transactions going through the network. So yeah, so the market cap of Bitcoin is actually $40 billion today, and there's a bunch of VC funding. You can see Bitcoin's volatility is going down a lot compared to, say, like the Brazilian real or some of these other like emerging market currencies. So this is Bitcoin, and it's over here right now. So it's obviously not as stable as like US dollar or like the euro or anything like that, but the volatility of it today compared to even like 2 years ago is decreasing tremendously. And then the other thing is a good way to gauge health of the network is number of transactions going through the network. And so this orange line is the price of Bitcoin, and this black line is the number of transactions going through the network. There's actually some scaling stuff that's happening with Bitcoin that's kind of it's kind of like bottlenecking some of transactions you can put through the network. But this graph actually holds pretty true for almost every single talk that we've been here through. So we're somewhere over here. And it's like up there somewhere. Okay, so the main thing I want to talk about is alternative blockchains. You guys might have heard about this. There's been a lot of press about Ethereum, ICOs, Ripple, Litecoin, Zcash. So essentially, these are all different blockchains that have different purposes. So Bitcoin is digital gold. It only has 21 million coins that will ever be minted in existence. And so people kind of think of it as like a very conservative protocol with conservative developers, and safety is pretty much the most important thing to the network. Some of these other blockchains, like Zcash, are more focused on, in this case, privacy. So there's a whole bunch of different kind of applications that you can make once you have fully confident transactions on the network. Pretty much large companies are not willing to sell large amounts of money on blockchains because it might be some tactical disadvantage if you are able to tell when Samsung spends like $2 billion. So this is kind of uses really cutting edge cryptography. It's called ZK Snarks. You guys can look into it if you're like math people. But essentially it encrypts the sender, the receiver, the timestamp, all like the stuff except for, actually everything except the timestamp is encrypted in Zcash. Really cool stuff. And then the one that's been getting a lot of traction and news coverage recently is Ethereum. Ethereum is essentially using a blockchain as a global state machine. So in Bitcoin's case, you have a list of pretty much balances, not balances, but like you can think of them as balances on the blockchain. Ethereum lets you store other things besides like numbers and balances. I think Bitcoin can actually also store other kinds of data, but Ethereum was specifically made for this. So the way you can think about it is like a global state machine, right? And reading from state is totally free, but if you want to write to state, then it costs money, which is their native currency, which is Ether. This is run by this like Russian or Ukrainian kid. He's like 23 years old. His name is Vitalik. A lot of the developers in this community are much more brazen. They like to do more hard forks, more protocol upgrades to the protocol and like the blockchain. It's much less conservative and much more kind of like move fast and break things. they're probably best known for dApps and ICOs, which is going to be the main portion of this talk. I think dApps and ICOs are very interesting. I think that they are definitely not proven, but it's a very interesting model to think about, because essentially what you're doing is funding the development of different kinds of network protocols. Okay, so if you can we get a thumbs check? Who has heard of Ethereum, first of all? Okay, what about ICOs? Okay, so essentially, an ICO is an initial coin offering. If I create a new network protocol, I'm going to have some digital bearer instrument that is required in order to transact on that network. And in order to raise money at the beginning, I'm going to sell that to other people who wish to use the network in the future when it has more users. All of these companies, startups that are making these things, they're collectively known as dApps. And when they raise money, it's called ICOs. So if you see these headlines about startups raising like $30 million with just like a white paper through an initial coin offering, that's what this is. Okay, so an example of this is actually Ethereum itself. In order for you to write to the global state machine, you have to pay Ethereum. It's the same thing. Ethereum had an ICO where they sold a large portion of coins to people who wish to use Ethereum in the future. Okay, so this model actually works really well, and maybe it works a little bit too well, because there's a lot more money raised in token-based ICOs over the past, like, I don't even know, like few months than venture capital in the entire space. This is in millions, so that's like $300 million. This is $140 million in venture capital. So a lot of money is pouring into the system. It's interesting. It's something to pay attention to. Okay, so why do you want to fund protocols this way? It solves the issue of funding decentralized protocols. If you think about HTTP, SMTP, SSL, some of these things that everybody uses, kind of like a public good, there is no incentive to create them or create new ones because you can't monetize them directly. The people who invented SMTP didn't monetize their protocol until Gmail, Yahoo, Hotmail came out much, much later. The developers who are creating these protocols are also typically compensated in the native token. So if their network does well, then they are also compensated more. So it aligns incentives. People who are early adopters to this network, when the network isn't fully built out or it has few users, are compensated by holding the native token if the network becomes valuable. And that also helps bootstrap the network. Okay, so this is like a lot of vague kind of abstract stuff. I'm just going to go straight to an example, which is if you imagine the value to the first Twitter user, right? That would be on this side of the curve. All right, you're like the only person in the network. There's nobody to tweet to. There's really nothing to do. But if you are on the other end of the network, by the time the network is much larger, you have a lot more value for everybody who's on there. On the other side, this is like kind of startup equity. If you are here on the beginnings, like the first hire at Google or something like that, the upside potential of working at said company is extremely high because you just get more portion of the network or more portion of the equity in the startup the earlier you start. But by the time you're like hire 10,000 at Google, you pretty much have very little upside. So these are the two curves imposed on top of each other. And the idea is if you can get users to join the network early, then it incentivizes this kind of bootstrapping that you inevitably have to do with any kind of protocol. But those initial users also have, it's solved by these initial users having the highest amount of upside by joining the network early. Okay, so this is taken from Fred Ehrson's blog post. How do you get people to join a new network? You give them partial ownership over it, just like equity in a startup. You get more if you join earlier. Okay, so this is the last thing is typical startups, the way things are built today, Facebook, Instagram, Twitter, Snapchat, they all essentially revolve around building moats around their product and then incentivizing people within them, right? You have like this walled garden and you send them ads or you monetize them directly and you make money that way. The app token model is actually most successful when just the utility of the protocol is maximized. So if you have the most amount of people using your protocol is actually the most successful. And if there is need for that token to be used in order to interact on the network, that token's gonna be worth more, right? So you actually want to build protocols that are modular, open source, and interoperable with anything else on the network. So you can think of a lot of these ICOs and dApps and stuff as modules that are being built on top of this network, where any one of them, if they are to become successful, become appealing. First of all, they're incentivized to be built in a way that they're able to be used by anybody as quickly as possible, as easily as possible. And for every successful protocol that's built on one of these networks, it enables another network to kind of hook into it and use it as another kind of power. So then here are some examples. Bitcoin didn't do an ICO, but it's definitely the progenitor of all this stuff. Ethereum is definitely like the original ICO kind of decentralized application. Augur and Gnosis are prediction markets. Essentially what it is anybody is able to make a prediction on anything. So like if you're in China and you want to own Apple, you can't own Apple from like a US stock trading company unless you're a US citizen or something. So you can make predictions. Like I think Apple will be $200 whatever by July, and then people can trade on that. It's kind of like a proxy for actually holding stocks, and you can do this on various things. Digix is asset tokenization. So if you have a car or something, or gold, or a house, you want to create some token that represents its ownership, then you could use something like Digix. Storage and Filecoin are essentially like you pay people to store your files distributed. So essentially what it is I will send a file to Bucko, and for every 10 days that's on there, there will be a heartbeat that comes back and says, I still have your file, I have the hash of the file, I can prove I still have it. And then I pay him a little bit in the native token, which would be storage coin or Filecoin. Maker is a stable coin, which is kind of complicated, but essentially it's a series of smart contracts that hold collateral on their own digital token, which is called the DAO, or not the DAO, the DAI. It's really interesting stuff. If you guys are interested in any of this stuff, you guys can talk to me afterwards. And then Golem is essentially like a distributed version, dApp version of AWS, where you have a bunch of miners, or not miners, but computers, general computing computers hooked into a network. And if you want to buy compute power from them, you can pay them in their digital token. Okay, and then this is the very last thing. The reason why I think this talk is really important is because whether you guys realize it or not, a lot of the stuff that we're talking about is like happening in SF as ground zero. So a lot of these meetups that you'll go to after you guys graduate, there are extremely high caliber people at these meetups working on very high profile projects, Lightning, Bitcoin, Rootstock, just like there's a bunch of really, really cool people and really cool stuff happening in the scene. And also all of this technology is becoming extremely accessible. So even like a year ago, some of this stuff was much harder to work on, but with stuff like Truffle or Bitcoin, a lot of this technology is really, 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 like the goal for all these things is massive adoption. So the tools are evolving really, really rapidly. And if seniors haven't decided on their senior projects or even juniors, it might be something to look at in terms of maybe finding some way to integrate it with your senior projects. And that's it.